Hello, my name is Jack Miller. I'm with GFC IB and Advisors. I thought I'd spend a few minutes today talking about mortgage modifications, particularly commercial mortgage modifications. When I say commercial mortgage, it could be a mortgage, it could be a loan, it could be equipment lease, but it has a commercial, it's not a residential owner occupied. We spend a lot of time working on behalf of our clients in the modification area, and there's a lot of misconceptions out there. I thought I would spend some time to clear them up. First of all, you have to understand, what is a modification? A modification is when you're going to your lender and saying, we already agreed to something before, but can you change what we agreed to? So obviously the lenders are not particularly happy because it has a lot of ramifications to them. Every lender is different, whether it be a CMBS lender, a bank lender, even within banks they all handle it differently, or a private lender. But in general, they're not happy about it because it means there's somewhere a weakness or a problem along the lines. Part of what we do and you need to do is understand their position and the ramifications to them. Understand by you modifying it or asking them to modify it, how does that change the way the regulators are going to look for the loan? Is it going to be considered a troubled debt loan? Is it going to be on the watch list or classified asset list? In the CMBS world, what does it do to the bondholders and all the stakeholders? So each one has a little different, and you have to approach each one differently based on the situation. But effectively, the number one thing to understand is you're asking them to change an agreement that you already agreed to. Again, it could be because of things that are outside of your control, but that's what you're asking for them. Oftentimes in the modification world, there's giveaways. You go to them and say, look, we're paying you X interest rate, here's the balloon, here's XXX, we want you to modify it to Y. And they'll say, look, we'll modify it to Y, but we want you to give this. So what's common is, for example, if you have another 8 years left on the balloon and you want a lower rate, they may say, okay, we'll give you a lower rate, but we want to take the balloon date out to 12 months or 24 months. Or there's trade-offs, or we may want additional collateral, or whatever the trade-off are, but there's usually a trade-off within a modification. When you go into the lender, you have to have an understanding of what you're asking for, what you want, how it will look to them, how it will affect the property or the situation, and what trade-offs you're willing to give. Typically, these decisions are made based on the economic realities, taking into consideration pressure from their outside source, whether it be the regulators, shareholders, or lenders. But you have to have all this in mind. It's not as simple as I want a modification. Some of the common things in the modifications that you negotiate on or you could bring up to the lenders are principal amount. What's the principal balance on the loan? Is the property underwater? Is it worth less now than it was worth when we purchased the property? No man is an island, and typically all of the 5 or 6 points I'm going to bring up all filter in together. If the loan is performing perfectly and if the property is rented out perfectly and has a great cash flow, you really can't ask for a reduction in principal. Reduction in principal only comes about because of something else. Oftentimes interest rates are negotiated. Are you paying above market rate? Do you need a below market rate? Again, it's hard to go in and negotiate a lower rate if the property is performing perfectly and it's fully leased out. So all these things go into the mix. The balloon dates and the maturities, that's critical. A lot of times loans are performing perfectly, but you have a balloon date and the borrowers can't refinance it, and the lender puts the loan in default. So balloon dates and maturity dates are critical when you're renegotiating. Amortization periods, whether it's fully amortized or interest only, that's another negotiating point. Releasing of the personal guarantee. Personal guarantees is a critical one. I say they're all critical, they are, because I see more and more lenders put borrowers in default because of technical reasons. So one of those is you need to see if you can get the personal guarantee released, but again, there's trade-offs for that. I said briefly the technical defaults and covenants. There are all kinds of defaults and covenants within the loan documents. The loan documents are literally probably 3 to 5 inches thick, and there's a million things in there that could put the loan in default with. I see more and more lenders put perfectly performing loans in default because of a violation of a technical, whether it be a debt service or something buried in there. It happens all the time. So when you're negotiating with the lender, make sure you take this time to look at the technical defaults and the covenants and see if you can negotiate them a little bit better. If the property needs capital improvements, you may look to the lender to fund the capital improvements, but you could also bring money from home. I can tell you, if you bring money from home and are willing to invest X dollars in the property, that goes a long way with the lenders, and they're more inclined to negotiate some of the other stuff. So again, the capital improvements and an infusion of cash, where it comes from, it helps out a lot, and you need to deal with that. In a short sale, not really a modification, but when you're doing a short sale, I often see short sales done without full releases of the guarantees. Make sure that whenever there's a short sale, you're not walking away with it without a full release of the personal guarantees. If not, the lender will come back to you years to come, so that's an important one. The lender's also going to look at how strong the guarantor is. If you have a really weak property but a strong guarantor, it's hard to get relief. It's hard to get them to modify it. There are ways, but if the lender thinks there's a pot of gold and a recovery there, you need to deal with it a different way. So factor that in. They also need to have confidence in you. If you're a total goofball and if you stuck your finger in their eye for years and all of a sudden now you want them to modify the loan, it's going to be tough to do. Ultimately, what we have to do is present a picture, and what we do is present a picture of the property or the situation as it's going on now, with a modification or without a modification. And we try to lay a foundation that the lender makes the right choice to modify the loan in some sort of way that's good for the property, because they're going to do what's good for the property, not what's good for you. The days of relationship banking are long gone. So we try to lay out a path for the lender to take that's good for the property. Frankly, what makes the difference with us, a little plug, is because we've been on the lending side of it, on the banking side of it, and on the borrowing side. We think we have a good handle on the best way to get a modification done. May not be all the borrower wants, but in any negotiation, it has to be a deal that everyone could live with, and we've frankly been very successful at it. Well, good luck if you're doing a modification. If we can help you, please feel free to reach out to us. We'd love to help you. Thank you.